Hello and welcome back, Forex students, and to our next tutorial entitled Margin and Leverage. Essentially what we're looking at here is part of the reason why people want to trade Forex, part of the reason why people lose money trading Forex, and part of the reason why people make money losing in the Forex markets. Margin and leverage, which essentially tells us how much, now that we know pips and exchange rates and pip value, how much do we actually have to put up to go into these trades? You know, how much of our own money do we have to put up to control these larger amounts of money that we see in the market? And that has everything to do with just knowing what your leverage amounts are and how that's applied in calculating your margin requirement. But first, let's talk about leverage. And I pulled this out of the dictionary. This dictionary term of, what is the definition of leverage? The use of a small initial investment, credit, or borrowed funds to gain a very high return in relation to one's investment. That's true. To control a much larger investment, which is also true, or to reduce one's own liability for any loss. Don't know if that part of the leverage definition applies to Forex, because you do have quite a bit of liability for loss in this market. So when we're talking about leverage, which I believe is the double-edged sword, whenever I ask people, why do you want to trade foreign exchange? Or, as I have a background as an options and a futures trader also. So when you ask people why do they want to trade options, futures, Forex, of course the phrase that they're going to say, what they're going to reply with is, well, I want to make money. And I usually say, okay, congratulations, you're so much different than everybody else. The thing about leverage and the way it works in foreign exchange is that there are advantages to utilizing leverage. A low initial deposit with a high rate of return. Translated to, you put up a little amount of money to make potentially a larger amount of money in a short period of time. However, that's all fine and dandy. Let's talk about some of the disadvantages of leverage. One of the probably the biggest disadvantage of leverage is just the opposite of what I just said. You can also put up a small amount of money to lose a large amount of money in a relatively short period of time. That's why in all of the courses that I teach, we go through money management quite a bit as far as managing your risk, because that's, leverage equals out to risk in Forex trading. So the risk considerations that you have to make before coming in and trading the Forex markets is, you have to have a relatively strong stomach, because yes, you can make larger amounts of money. You can make in a short period of time. You can lose large amounts of money in a short period of time. Your risk tolerance level has to actually be pretty high. If you're, let's say, a retiree and you don't really have any risk capital, you've been used to trading in bonds and low yielding assets and low yielding mutual funds to remain pretty conservative in your income generation and capital preservation, then the Forex market may not be for you. However, if you do have a percentage of your capital, they call it asset allocation, where they allocate your assets into like growth and income and capital preservation. There's usually a smaller amount of assets that you have that you can put into higher risk, risk exposed assets like Forex trading. And that's usually a small percentage of your overall investment income. So when we're talking about leverage, that is what makes the market worth trading. That, if we didn't have leverage in this market, probably the average retail trader would not be able to trade it. But since we do have leverage, that is what is allowing us to put up these small amounts of money to control these large amounts of currencies. As far as the margin requirements go, it's actually a very simple calculation. And it's all based on where you live. For those people that live here in the U.S., a little bit, probably what was it, about 2010, I believe, is when the Dodd-Frank Act came out, to where it limited the amount of leverage involved in the Forex market. We used to have access to like 100-to-1 leverage, and now we're at 50-to-1. So whenever you hear leverage being quoted, some of you overseas may have access to higher amounts of leverage. For us here in the U.S., we have a top-end leverage amount that we can have here in Forex trading of 50-to-1. That's the maximum amount of leverage we're allowed to have. And that calculates over to a 2% margin requirement. What is margin requirement? It's the minimum amount of funds, minimum amount of equity you have to maintain in your account in order to hold a position. And don't worry, after we get done with this tutorial, our next tutorial, we'll go live into a trading account and show you how this affects your account balances. So as far as the actual calculations for leverage, depending on what your lot size is, for example, a standard lot is 2% of the base currency exchange rate to your account currency. What that means, what does account currency mean? Well, if you live in a different country, you probably hold your account in Aussies, or if you live in Europe, you may hold your account in euros. You're making or losing money in your account in euros. So it all depends on what the base currency is. So it's 2% of the base currency exchange rate to your account currency times your lot size, which in this case, if you're trading a standard lot, would be 100,000. A mini lot would be 10,000, and a micro lot would be 1,000. So for an example, if we were to buy one standard lot of the pound dollar at 1.59422, and that's the exchange rate. Now, in this example, I'm using a US dollar based account. I live in the US, so I'm making and losing money in US dollars. It would be 2% of that exchange rate, because that exchange rate is telling me how many dollars it takes to exchange for 1 pound. So 2% of 1.59422 comes out to 0.0318844. I would take that number, multiply it by the lot sizes that I'm trading. So it'd be 3188.44 would be the minimum margin requirement. Or in my account, that would be the minimum amount of equity I'd have to maintain in my account to hold this pound dollar position on there. So that would be my margin requirement. So if you have, let's say, a $10,000 account and you were to open up this position, they're going to put this 3188.44 on hold as a margin requirement. So of your $10,000, you would not be able to allow that pound dollar position to go against you to where you could not maintain a minimum equity in your account of 3188.44. That would be called a margin call, which we'll get into next. Which, if you have a $10,000 account and let's say the value of that pound dollar position dropped to where your account value was now $3,188.43. Well, you're going 1 cent below your margin requirement, and thus that would trigger what we call a margin call. But think about it this way, you're putting up, in this case, $3,188.44. That's your margin requirement, but you're also controlling a position of 100,000 British pounds via that exchange rate. So that's, when you think about it in those terms, it's actually a very large amount of leverage in what you're controlling. If you were happen to do mini lots on this trade, it would be $318.84 if you were trading on increments of 10,000. Or if you're trading micro lots, it'd be $31.88 would be the margin requirement they would put on hold for this position. So as you lower the amounts that you trade, the increments in which you trade in, you're putting up less margin. Thus, you're also making or losing less amounts as far as your pip value goes. Now let's get into a little bit into margin calls. What is a margin call? Well, most brokers have what's called an auto liquidation policy. Now what this means, and I can't speak for all brokers, but I can only speak to the majority of brokers that I know of have what's called auto liquidation. What that means is if your account can no longer meet that minimum amount of equity in your account, if it slides below that, then they're going to automatically liquidate your position once it can no longer meet that minimum margin requirement. So auto liquidation just means that your computer or your platform or your broker does not give you the chance to deposit funds into your account. What they're going to do is they're going to automatically liquidate your position to put that margin back into your account in order to meet your margin call and meet your minimum equity requirement. Some brokers do these in different ways. There are some brokers out there worldwide that if you have, let's say, 5 different positions on, some of them have a broader auto liquidation policy to where they will liquidate all of your positions and put you into 100% cash in your account. Other brokers, a lot of the US brokers here in the US, they run things a little bit different to where if you have, let's say, 5 different positions on and you were to get a margin call, they would liquidate whatever the first position was that you put on. They have kind of a first in, first out. They would start with the first position, liquidate that. The computer automatically can read which positions have to be liquidated to meet the margin call until your margin call is met. Most of my students should never have a margin call because we do this thing called risk management. However, there are some out there that like to trade by the seat of their pants and be overly aggressive. That margin calls can be a frequent thing for them in the market. And the reason why they have auto liquidation with most brokers, meaning they don't, and all auto liquidation means is that, you know, the computer does it automatically once your account runs out of usable margin or runs out of equity. I used to work in the options desk, for example. They do this in order to prevent you from going what we call lick to def, which is liquidate to deficit. The reason why they have that auto liquidation policy, because if they don't want your account going into negative territory. You never want to be in a position, and trust me on this, as an options trader, we used to have large institutions and retail customers to where we would give them opportunities to deposit funds, and whenever that we didn't have auto liquidation, we would call them and say, hey, you have minimum equity requirement of $150,000. You currently only have equity of $100,000. If you don't bring in $50,000 by the close of business today, we're going to have to liquidate one of your positions. Well, sometimes that can turn negative on them to where you're owing a broker more than what's actually in your account. So if you open up a $10,000 account, they do it so that you don't have to end up owing them $2,000 or $3,000 or $4,000, and that's with just that's just becoming a collections agent at that point for the brokerage company. So a margin call example would be, let's say if you had a $10,000 account and you bought 2 standard lots of the dollar yen, say 80.317. You have to put up 2% of the base currency. So in the US, that would be 2% of $100,000, which is $2,000 per lot. So your balance is $10,000. That means you used margin out of your account. Your margin requirement would be $4,000. Your usable margin would be $6,000. Now what that number means, that's also can be shown up as your equity amount in your account, your usable margin number. That just means that dollar yen position that you put on, should you not use any stop orders, should you allow that dollar yen position to move against you by the maximum amount that it possibly could, if that dollar yen trade were to move against you by $6,000, then they're going to liquidate your position and release that $4,000 back into your account. So to avoid margin calls, which essentially means just making sure that you manage your risk appropriately, don't risk more than a certain percentage of your account on each individual trade, don't over leverage your account, don't put on positions and try to go cowboy on the market and make up, be a millionaire overnight, George Soros style, out of your $5,000 account. Just means do not over leverage. When you're trading in the Forex markets, it's a marathon, not a sprint. It's about building a good, decent view of the market and trading consistently. It's not about making all your gains that you want for an entire year in one day. And money management, which is one of the other tutorials that we'll be having here in the upcoming future of how to maintain and manage your risk exposure in the Forex markets. So you're probably wondering at this point, well, how does this actually work in a real account? Well, in our next tutorial, we'll go through some live examples of margin and leverage and show you how it actually affects a live trading account, in this case a demo account, to show you how it works. So with that being said, I will chat at you in the next tutorial, and thank you for coming in.